In September, a surprising IPO listing made the news. No one expected the Anand Rathi share and stockbrokers listing to trigger any fireworks. After all, the 30-year-old old school broker isn't exactly the poster child of fintech ambition. And yet, its almost 750 crore rupees IPO drew bids worth more than 20 times the original offer. The stock did extremely well, especially considering the sluggish market at the time. Now, the stage belongs to another player that changed how India trades: Groww. The company goes public today and is reportedly seeking a valuation as high as $9 billion. dollars. That's the biggest IPO in India's broking space till date. Of course, Groww has put its best foot forward. In its DRHP, it boasts more than 4,000 crore rupees in revenue and nearly 2,000 crore rupees in profit for FY25. That's three times higher than its profits last year. Meanwhile, its biggest competitors like Zerodha and Angel One were struggling, thanks to SEBI's crackdown on the FNO or futures and options party. For context, FNO are basically trades where people bet on stock prices rising or falling at a future date. High value trades of this nature are risky but rewarding for retailers, and a big source of revenue for apps like Groww, Zerodha, and Angel One. So, when SEBI started introducing stricter rules, Zerodha's annual profit fell about 20% and Angel One's barely grew. Groww, meanwhile, seemed to be defying gravity. This was also the year that Groww went all out in diversifying. Beyond its core broking business, Groww now has its fingers in multiple pies, from mutual funds to payment solutions to lending. It was clear that the discount broker had its sights set on becoming a full blown supermarket for financial services, with a special focus on lending as its big new bet. Except if you look deeper into the maze of numbers in Grow's IPO documents, you will realize that its stellar performance isn't all that it is made out to be. Welcome to Daybreak, a business podcast from the Ken. I'm your host Rachel Verghese, and every day of the week, my co-host Snigdha Sharma and I will bring you one news story that is worth understanding and worth your time. Today is Tuesday, the 4th of November. In the year ended March 2024, Groww incurred a significant tax expense, which amounted to about 1,500 crore rupees. This happened because the company shifted its domicile or legal base from the US to India. You see, moving countries like that means you often have to settle large tax obligations. What also happened was that Groww paid a one-time performance incentive of nearly 800 crore rupees and a long-term incentive of a little about 100 crore rupees to its top management during the year. This, along with other staff costs, quadruples Grow's employee expenses in FY24, which directly affected its bottom line. Now, if it weren't for these costs, the company would have actually made a profit of over 1400 crore rupees that year. This was as opposed to the little more than 800 crore rupees loss it actually ended up posting. But in FY25, the long term incentive of 100 crore rupees was cancelled and reversed, which of course added to Grow's profit. Basically, if not for this, the company's bottom line would have come in lower at about 1700 crore rupees. Now, on paper, even with that change, gross profit growth in FY25 would still have been about 20%. Except, even if it was still outpacing its peers, the difference would not have been quite as dramatic. So, overall, the dream run in trading volumes, that is, until SEBI's squeeze on the FNO business began in late 2024, meant that FY25 was spared the worst of the blues. But the full impact of this move and other tightening regulations is expected to manifest in the current year ending in March 2026. The hit has already started to show in the June 2025 quarter for Zerodha, which saw a 40% plummet in brokerage revenues. Even Angel One saw its sales fall about 20% year on year, with profit falling even more. From the looks of it, Groww managed to dodge the trend by growing its profits 12% year on year to almost 400 crore rupees during the same period. But there's another one-off cushioning the blow here as well. The reported profit of a little more than 300 crore rupees for the June 2024 quarter was dragged down by a long term incentive of almost 160 crore rupees to the top management. That was an amount that was reversed in the same year. If not for that reversal, gross profit for that quarter would have been nearly 500 crore rupees, which in turn would mean that the company posted a 25% decline in profit in the June 2025 quarter. And it's not just profit. Gross sales too fell about 10% from the year before. The main issue? Broking income. It was down by nearly 20% thanks to weaker trading volumes and fewer new investors joining the platform. In fact, new active users nearly halved from a little short of 2 million a year ago to less than a million this June. Still, broking accounts for a big chunk of Grow's overall revenue, but its share has been declining continually. A year ago, the segment contributed 90% to the company's top line. In June 2025, it dropped below 80%. So, Grow's strategy to try and make up for the slowdown in the broking business, even if it is marginally, are other verticals, which include everything else the company has bet on. More on this in the next segment. In early October, Groww got the green light to buy Fisdom, a wealth tech startup. This move officially opened the door for Groww to enter the wealth management game through its unit called W, which focuses on serving the rich. Now, while Groww has also been experimenting with other businesses like asset management, payments, and insurance broking, they are all still pretty small. One segment that's really taken off, though, is lending. You see, gross income from loans and MTF or margin trading, which is basically when traders borrow money to buy more stocks, grew by almost 10 times in FY25. Then later, it more than doubled in the June quarter. So clearly, Groww is stepping on the lending accelerator. From its over 1000 crore rupees IPO issue, over a third has been marked for investing into its lending arms. These arms are Groww Credit Serve, which gives out unsecured personal loans, and Groww Invest Tech, which runs a margin trading business. Now, as I mentioned earlier, margin trading or MTF lets customers buy stocks by paying only part of the cost upfront, while Groww covers the rest as a loan. This arm of Grow's business has scaled rapidly. To put it in perspective, Grow's MTF loan book as of June 2025 stood at over 1000 crore rupees, rising nearly 8 times from the June 2024 levels. The interest income from it now makes up about 3% of Grow's total revenue, which is up from almost nothing a year ago. And the MTF loan book is only set to grow further. This thanks to the fund infusion it will see post the IPO. It also hiked the interest rate on MTF loans in June to about 15% per annum. It's a move that could also help the company generate more money per user. You see, clients opting for MTF tend to spend more than others. And at less than 3,500 rupees, Grow's average revenue per user is among the lowest compared to competitors like Zerodha, Angel One, and Dhan. The only thing is, Groww isn't the only one doubling down on MTF. From Anand Rathi to Zerodha, most stockbrokers are in on the game now. In fact, the overall domestic brokers MTF loan book crossed the rupees 1 lakh crore mark in September, which is more than 2 times higher than just a year ago. So, of course, rising competition could put pressure on interest rates. You see, unlike stock and derivatives trades, revenues from MTF carry a much higher risk. Both clients and brokers take a hit if the bets go wrong and clients are unable to pay back. Still, the dominance of broking in Grow's revenue mix means that MTF and other lending income will take a long time, if at all, to make any meaningful difference. It doesn't really help that all its other businesses, except its broking and MTF arm, are loss making or have negligible profit. So, the pressure doesn't seem likely to ease anytime soon. But Groww isn't afraid of aiming for a much higher price tag than its rivals when it goes public. Now, if it's valued at around $7 to $9 billion, that means investors would be paying almost 30 to 40 times what the company earned in profits last year. Just to show you how high that number is, let me tell you what other brokers trade at. For example, Angel One and Anand Rathi trade at just 20 to 25 times their profits. But Groww is aiming even higher. Even if Grow's wealth management vertical is yet to take off in any meaningful way, it's comparing itself not just to brokerages but also to wealth managers like 361, which usually enjoy premium valuations. And that's not all. It also lists Robinhood, an international discount brokerage, and Prudent as a peer. Now, Prudent is a mutual fund distributor that distributes regular plans and earns commission income. Groww, on the other hand, doesn't earn a fee when it distributes its own plans. So, here's what it all looks like. Even if its bottom line tells a sobering story, Groww is counting on its size and narrative to make its grand entrance in the public market.
Daybreak is produced from the newsroom of The Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings. A full subscription offers daily long-form feature stories, newsletters, and a whole bunch of premium podcasts. To subscribe, head to theken.com and click on the red subscribe button on the top of the Ken website. Today's episode was hosted and produced by my colleague Rachel Varghese and edited by Rajiv Sien.